Quick question for you. If you invest in a stock and at some point in time it's worth this, and then it drops to this, have you lost money? What about now? Back in the 2008 bear market, there was a day where Warren Buffett's portfolio was down over $10 million. Someone asked him, how does it feel to lose $10 million? His response was, I didn't lose any money. I didn't sell it. It went down in value, but I didn't sell it. And it'll come back up again. Until I sell, I haven't lost money. Imagine you paid $500,000 for a house. Then there's a bad real estate market, and you find that if you were to turn around and sell it, it would only fetch $400,000. Have you lost money? The answer is only if you sell it while the value is down. If you end up holding that property and sell it years later or a decade later for $1 million, you didn't lose any money. You turned $500,000 into $1 million. You did experience price fluctuation in its value along the way. Investing in stocks is like that. When I say stocks, by the way, I mean stocks. I'm not talking about one company. If you owned one company, it could go to zero and never come back. Those of us who were around back then will remember the Lessons of Enron, which went from $90 a share all the way to zero and it never came back. So when I say stocks, I mean stocks, a very diversified portfolio of high-quality companies. Think S&P 500. Prudent investing in stocks requires a long-term perspective. When you're invested for the long term, think the rest of your life, you're going to experience market ups and downs along the way. Instead of worrying about market downturns, I want you to think about them in terms of presenting you with opportunities. Warren Buffett said, I'm happiest when stocks go down. That way I can buy more of them with the same amount of money. Let's say you're investing $1,000 a month into a stock. If it's trading at $25 per share, how many shares does your $1,000 buy you? 40. What if the value of that stock were to drop from $25 per share to $20 per share? Is that a bad thing for the long-term investor? No, because now your $1,000 will buy you 50 shares. So these periodic market downturns actually benefit the long-term investor. If you're already fully invested, let's say you've been contributing for years and decades to a retirement plan, now you've retired, you've rolled it over into your IRA, you say, I'm not buying anymore, so this doesn't benefit me. Keep this in mind. The investments in your portfolio probably are paying dividends periodically, and they're probably being reinvested back into additional shares of those same investments in your portfolio. As long as the reinvested dividends are greater than the amount that you're pulling out, maybe you're taking money out monthly, as long as they're reinvesting more than you're pulling out, you are indeed continuing to buy more shares and will benefit from temporary market downturns. Now, maybe you're not as young as you used to be, and you might be thinking, I don't have time for the markets to recover. If you're like most of our clients, you're probably not pulling all of your money out at one point in time. You might be supplementing or planning to supplement your retirement income by taking money out of your accounts periodically. It's important to remember that because if the markets are down right now, it might be natural to say, I've lost money. If I had to sell today, it's down. But you're not going to be selling all of it today. You'd probably be selling it at 20, 50, 100 different points in time along the way throughout your retirement. And each of those sales will have a different price. Today's value won't matter a year from now, 3 years from now, 5 years, 10 years from now. And again, if you're saying, well, I may not be around that long, what if I die and the markets are down? Sometime back when the markets were down at the moment, one of our clients called in. Now, this client in her IRA account had a beautifully diversified portfolio. At the moment, the markets were down. She said, what if I died now? Then everything you're saying about how it's going to come back up again won't matter. It'll be down when I die, and that's that. We then went on to talk about the fact that her kids were her beneficiaries. And we talked about that the smart thing for them to do is to take her IRA as an inherited IRA. They each have money come to them. They can open an inherited IRA, take their portion of her proceeds into that, and let it be rest of their life money for them. Or at least take advantage of the fact that the IRS allows them, under current law, to take up to 10 years to withdraw the money from an inherited IRA. So again, the price at any one point in time isn't as significant as we think. It's important for those who invest in stocks to understand what to expect. The long-term rate of return on stocks, as measured by the S&P 500, is something like 10% per year. The long-term rate of return on bonds has been 6% per year. The long-term rate of return on cash has been about 3% per year. Now, if stocks pay that much more than bonds or cash, what's the catch? There's no free lunch, is there? There's no something for nothing. So what you're going to want to know if you're invested in stocks or considering investing in stocks is that there is a price to pay for those higher rates of return compared to other assets. And that price is we must be willing or even eager to endure the temporary short-term market fluctuations that stocks will exhibit. And if you cannot endure the market fluctuations, you might not want to be invested in stocks, or not all invested in stocks. You might want to consider other assets like bonds or cash. Just understand, as you go down from fluctuation, from stocks to bonds to cash, all along the way, there's a trade-off. The assets that are more stable have historically paid lower rates of return, whereas the assets that have paid the higher rates of return have exhibited the more significant short-term price fluctuation along the way. That's to be expected. It's the price we pay for the potentially higher rates of return. The markets have a long history of ups and downs. Knowing that, expecting that, will help you keep a long-term perspective. What about timing the market? Maybe if the market's down, we should get out and then get back in again when things look better. Studies have shown that the long-term rate of return on the average stock mutual fund is something like 10% per year. Meanwhile, the average rate of return for the average stock mutual fund investor is something like 6% per year. One of the reasons for the lower return is that a lot of stock mutual fund investors try to time the market. Get out, get back in, get out, back in. It seems market timers are more likely to underperform than overperform the markets. Also, don't forget the tax implications of selling. Let's say you bought a stock for $25 per share, and it went to $50, and then it dropped to $40. Maybe you're thinking, I'll get out of the market and get back in again when I like the markets better. Don't forget, you bought it for $25, you still sold it for $40, not as high as the $50 temporarily was, but you bought it at $25, it's now $40. That's a capital gain. It could be subject to capital gains taxes. Holding on to the stock for the long term can defer those taxes. If you don't have a long-term strategy, an investment philosophy, I suggest you develop one. Having and knowing and staying true to your investment philosophy can help you to make investment decisions and avoid emotional reactions to short-term market fluctuations. Emergency funds. Having an emergency fund can be a great help to help you endure the down markets. Again, you only lose money in stocks if you sell while it's down. Having cash in an emergency fund elsewhere means you don't have to sell your stocks while they're down to come up with the cash you need. I know that when the markets are down, it's easy to worry, especially if you're watching the financial news. Don't get caught up in the herd mentality. Remember, the financial news, their goal is ratings, sensationalism, clicks. Their best interests are very different from your best interests. Keep your investment strategy, your goals in mind rather than following the herd. A financial advisor can provide guidance and support. Consider consulting a financial advisor to help you make informed decisions. Our contact information is in the description below the video. Reach out if we can help. For an even deeper dive on how to invest your long-term money, watch this video next.